Welcome to the Lehman Tax Law Library. I'm Richard Lehman. I've been practicing law for 50 years now, and I've been lucky enough for the last 10 years or so to be specialized in a few different areas of the law. I've made videos on these specialties starting several years ago. And all of these videos are in an archive because people are going to still be needing to go back to the pre-Trump tax law on cases that they're working on. A few months ago, I decided to update all of the videos to focus on the changes made by the new Trump tax bill. Each one of these new videos has a short article that goes with it that will point out to you the highlights of the new videos. Though there are not a lot of changes, the changes are dramatic and will make a difference on many levels. And hopefully it's a tax bill that is for the best. We'll have to wait and see on exactly how all of this plays out. And I hope these videos will be helpful to you. Thank you for watching. We're now going to take up the subject of pre-immigration income tax planning and estate tax planning. We are talking about an individual who is presently an alien individual. That's not a U.S. citizen. And that alien individual is not a U.S. tax resident either. They live all over the world and they may come here to do business, but only a selected amount of them are coming here intending to become U.S. citizens or permanent residents in the United States. And when they do become a citizen or a permanent resident in the United States, they become a different kind of taxpayer. When they are here as visitors, not spending a certain amount of time here, they are called non-resident alien individuals. When they are here and they are now taxed as U.S. taxpayers, they are either going to be resident alien individuals, which is people who have a permanent green card. They will be called resident alien individuals because they spend a certain amount of time here. And they will be called citizens when they become citizens of the United States, which many do. We're talking about the taxpayer who comes here to the United States and is thinking of becoming a U.S. taxpayer for the duration. They have to, before they come here, they have to get their houses in order, because if they don't have their houses in order from a tax standpoint, they're liable to come to the United States and they're liable to cost themselves a lot of money in taxes that they'll be paying to the United States that they really shouldn't have had to pay, because it's money based upon wealth that they have accrued before they came here, income that they have accrued before they came here, and instead of having a fresh start here, they will be paying taxes on monies that they've earned in the past. So that's the essence of pre-immigration income and estate tax planning. And we'll see as we move on, there's a completely different definition between a taxpayer, an immigrant who is a taxpayer for income tax purposes, and an immigrant who's a taxpayer for estate tax purposes and gift tax purposes. But we'll see how all of that unfolds. I was thinking about the title of this. It was interesting to me to think about all the fighting over immigration and illegal immigration. And what we're going to be talking about is the people who are legally immigrating here. And you can probably say, for the most part, this is tax planning for the wealthy. Those are the people who can come here because their services are wanted here, who have been successful in their own countries and want to have a little more peace and quiet than they have in their own countries, a little more safety or a lot more safety than they have in their own countries. So we're going to be essentially tax planning for pre-immigration for the wealthy individual. Now, we're talking about an individual who's presently an alien who's going to become a U.S. tax resident, first for federal income tax purposes. Once that happens, they are subject to tax on their worldwide income. They may also become U.S. tax residents for estate tax purposes. This is a different definition. This means if they were to die in the U.S., there will be a tax on their wealth, like the wealth transferred at death to beneficiaries. If they become U.S. tax residents for estate tax purposes, they were going to be subject to tax on their worldwide wealth. I'm going to just give one little story to put this in perspective on how I was made aware of how important a subject this is. Many, many years ago in my practice, when I was just getting started, I had a gentleman come in the door, and it was sometime in January or February of the tax year. The gentleman was 65 years old. He had been collecting Ecuadorian Indian art for the last 40, 50 years of his life. And he had a major Ecuadorian Indian art collection. At the time that he was collecting it, the Indian art was very inexpensive, and his entire collection had cost him a little bit more than $50,000. The gentleman came to see me as a tax lawyer after he had become a U.S. taxpayer. After he had become a U.S. taxpayer, by virtue of him staying here for a certain period of time, is when he sold his Ecuadorian art collection for about $3 million. And I had to tell the gentleman there was nothing I could do for him, that he had a basis or a tax cost in his Ecuadorian art of $50,000. He had sold it while he was a U.S. taxpayer for $3 million, and he now is going to have a capital gains tax on all of his hard work before he got here on $2,950,000. That was a wake-up call to me on what needed to be done for non-resident aliens who are going to become U.S. taxpayers. The earnings that they've made outside the United States, they may be accrued earnings. They may have gains from assets they own or income that they will not collect and is not going to show up until after they've moved to the United States. These are the gains and the income that they have to plan for in advance. This seminar is going to discuss the tax planning techniques to preserve this wealth, the earnings and the fortunes, that the U.S. taxpayer who is immigrating to the U.S. has earned prior to their tax residency. We'll examine how to avoid the traps. First, let's define the non-resident alien versus the resident alien from a tax standpoint. The resident alien is going to be subject to taxation on their worldwide income, similar to the U.S. taxpayers. The non-resident alien needs the tax planning before he becomes a resident alien. The U.S. resident alien is going to be subject to tax just like a United States citizen. They're subject to tax on their worldwide income. They're subject to tax on their worldwide assets and the estate tax on their worldwide asset, and they're subject to the gift tax on their worldwide assets. Now, let's first list a few of the ways that people become U.S. taxpayers, and then we're going to consider them in more detail. 1, a taxpayer can become a U.S. citizen by way of marriage. 2, an immigrant may elect to be taxed as a U.S. resident by electing that status on their U.S. tax return. 3, the U.S. grants the right to permanent residency to immigrants. This is the issuance of what's commonly called a green card. The green card holder will be a U.S. taxpayer. We'll see the timing on when they become a U.S. taxpayer a little later in the discussion. U.S. tax residence also can occur because someone has for income tax purposes. When someone has a certain physical presence in the United States that lasts a particularly long period of time. Individuals who physically spend a certain amount of time in the U.S. can be subject to a U.S. income tax as tax residents and be taxable on their worldwide income, even though they don't live here. The amount of time that they're physically present here has caused them to be considered to be, for that particular year, a resident alien. And this is what happens under what we call the substantial presence test. These are individuals who have been here under a certain formula for too long a period of time and cause them to become U.S. taxpayers. There are 2 exceptions to this substantial presence test, and we'll discuss these substantial presence test, and you'll see what that looks like. But I'm going to at least quickly look at the exceptions. The first exception is called the closer connection exception. The closer connection exception is when an alien has come here to the United States for a period of time that is less than 182 days in each and every year. And that individual has what's called a closer connection to another country, which essentially means that that taxpayer has more family in another country, more business in another country, home in another country, where there is what we call a closer connection to the other country. They can spend up to 182 days a year here every year without becoming U.S. taxpayers. And finally, we have tax treaties all over the world. There's many more than 50 countries that we have tax treaties with. And under a tax treaty, we have a unique definition. And people who are governed by tax treaties can actually be here in the United States for more than 182 days a year, and still, because of the particular treaty that they are governed by, can, even though they've been here under time periods that most immigrants would be considered to be tax residents, the treaties make sure that there's a degree of even more permanence here in the United States before the United States is going to start claiming that an immigrant is a taxpayer for U.S. purposes if they are governed by a treaty and still have several close ties to their home country. The non-resident alien is not a resident alien, And the resident alien, like we say, will have a green card, a permanent residency card, will have been here a substantial presence for a substantial time period that is defined and that they violate, or by election. The exceptions, the closer connection exception, and tax treaties. We're going to look first at the income tax situation. Once you become a U.S. tax resident, you're subject to income tax on your worldwide income like every other American. You're subject to tax on the graduated tax rates. These rates now start at 10% and can go as high as 37%. And there's additional taxes on investment income under certain circumstances. There is a U.S. tax, and there are other taxes that can be asserted on immigrant taxpayers here by virtue of city and state income taxes. Florida, for example, has no personal income tax. New York City and state, if you're living in New York City, your income taxes are liable to be higher than more than 10% of additional tax. The first item that we're going to look at as to a non-resident alien immigrant who can come to the United States for a long period of time and still not be considered to be a U.S. taxpayer, we're going to take a look at what do the tax treaties do. The first thing we're going to look at is what are the rules under the tax treaties to determine whether a taxpayer is a U.S. taxpayer or a taxpayer in his treaty country. The term a resident of a contracting state means any person who, under the laws of that state, is liable to tax by reason of their domicile, residence, citizenship, or other criteria. The term doesn't include a person who is liable to tax in that state in respect only to income from sources in that state or capital situated therein. In the case of income derived by a partnership, a trust, or an estate, residence is determined in accordance with the residence of the person liable to tax with respect to such income. Under the tax treaty, we have several what we call tiebreaker rules, which means that if a person has been here more than the 182-day time period, we look to see where is that person's first real place of domicile, where they really have most of their ties to. If they have most of their ties in the United States and they have spent a certain amount of time here, they will be considered to be U.S. taxpayers. The tax treaties will have several rules that we call the tiebreaker rules. And this is because we're trying to decide whether an individual here from a treaty country really still belongs to that country for tax purposes, whether he is being taxed as a permanent taxpayer in their own country, or whether that person really should be taxed by virtue of his presence in the United States because the taxpayer is spending a great deal of time in the United States. We go through a group of what is called tiebreaker rules to determine where does an individual belong when it comes to being in a tax treaty country and coming to the United States and having a degree of permanence here. These are the rules, what we call the tiebreaker rules. The first tiebreaker rules is where did the person who's been in the United States under a tax treaty for more than 182 days, where did they have a permanent home available to them? If there's a permanent home available in both states, then the taxpayer is going to be deemed to be a resident of the state in where his or her personal and economic relations are closer. We call this the center of vital interests. Now, if we have a tie where there is a permanent home available to a taxpayer in both states, and we have an equal amount of personal and economic relations that that person has with the United States and his or her home country, then we look to what we call the habitual abode. Now, habitual abode is a fancy name for basically saying where did they spend their most time during the year. If they had permanent homes in both, businesses in both, family and personal relationships and economic relationships in both, then where did you spend the most amount of days? And that's going to decide it. And that will be the tiebreaker, where if someone has everything equal and they've spent more time in the year in the United States than in their own country, then under the habitual abode, they're going to be considered to be a U.S. taxpayer. Now, it's possible to have a habitual abode in both states or in neither of them. And under those circumstances, the taxpayer will be deemed a resident of the state of which he is a citizen. So if you are here in the U.S. too long a time period, you are under a treaty, you have equal participation, family, business, home here, you have an equal amount of time that you spent in both countries. At that point, we look to the state in which the person is a citizen. Now, if each state considers that person to be a citizen, or that person is a citizen of neither state, then the authorities of both countries have to meet and settle and decide who has first dibs on this person as a taxpayer in our country. So that's the tiebreaker rules for treaties. And what that does is permit people under tax treaties to spend more time here than the average person and not be a U.S. taxpayer for tax purposes, but rather will continue to be non-resident aliens for tax purposes. So that's the treaty. The other tests that we have to determine whether somebody is a taxpayer here or a taxpayer in their home country when there is no treaty involved. The first thing that we have is called the substantial presence test. The individuals who come to the United States and have a substantial presence here, and this is a result of how much time has been spent in the United States in certain calendar years. And if that person has a substantial presence in the United States in a particular calendar year, the starting date of when they will be considered to be tax-paying individuals will be the first day during the calendar year in which the individual is present in the United States and they have met the substantial presence test. Now, what is the substantial presence test? The substantial presence test is pretty straightforward. A person can continue to be a non-resident alien who is not subject to tax on their worldwide income so long as they have not been in the United States for more than 182 days based upon a certain formula. The formula looks at the year in which we are determining whether they are U.S. taxpayers or not. In the chart in front of you, it's the year 2017. The non-resident alien, who continues to be a non-resident alien, came here for 120 days in the U.S. in 2017. He or she was here for 40 days in the U.S. in the year 2016, and he or she was here again for 20 days in the U.S. in 2015. So determine whether this person is here for more than 182 days in the year that we're measuring, which is 2017. There's a formula. We count every day in the measurement year as 1 day for every day the person stayed here. We count every day in the year before that as 1/3 of a day towards determining whether they're here for 182 days or more. And we look at the year 2 years before the measuring year, and we count every day as 1/6 of a day. So you'll see under this formula, under the substantial presence test, the person who remains a non-resident alien is on the left-hand side because they have only 20 days counted towards their presence here for 2015, 40 days counted here for 2016, and 120 days counted here for 2017, which means they've only been here 180 days for the year 2017, and they still are non-resident aliens. Now let's look at how somebody can become a resident alien under this formula. And here we're saying that the resident alien spent 120 days in the U.S. in 2017, 150 days in the U.S. in 2016, and 120 days in the U.S. in 2015. Now, when we use that formula, we have for the year 2015, 1/6 of 120 days is 20 days. For the year 2016, 1/3 of 150 days is 50 days. And for the year 2017, 1 full day for each full day of 120 days is 120 days. And you can see when you add this up under this formula, the resident alien for the year 2017 has been here for more than 182 days, and that alien individual is going to be subject to tax like American citizens and permanent residents here in the United States on their worldwide income. We're also going to look at another way that someone becomes a resident for U.S. income tax purposes. And this is what is called the green card, which is a lawful permanent resident status, and it happens to be printed on a green card. And there, the moment someone becomes a green card holder, that's going to be the day on which they were lawfully admitted for permanent residence. In the case of an individual who is lawfully a permanent resident of the United States, at any time during the calendar year that he or she does not meet the substantial presence test, then the residency starting date is going to be the first day in the calendar year in which he or she was present in the United States on United States soil while they held the permanent resident green card. Now, there's a little twist here. People who go to the U.S. Embassy and get their green card in the U.S. Embassy, they are on United States soil. And if you get your residency that way, you need to be aware of the fact that you may not come to the United States for several months after that, but you've been on United States soil when you were issued your green card, and you are now a U.S. taxpayer. We're going to look at two different situations on how one measures the relationship of the green card, a permanent residency, and when that permanent residence starts, with the substantial presence test, and when that residence starts for purposes of when one becomes a U.S. taxpayer. Now, in the first situation, we're looking at an alien individual who had no physical presence in the U.S. for 2015 and no physical presence in the U.S. for 2016. And the non-resident alien did have the following physical presence in the United States from January 1st, 2017 to February 15th, 2017. The taxpayer spent 46 days here in the United States before the taxpayer got their green card. The taxpayer was then issued a green card on August 31st, 2017, and the taxpayer stayed in the United States from August 31st, 2017 till December 31st, 2017 for a total of 123 days. Well, we look at the year 2017. The taxpayer, under the substantial presence test, did not spend more than 182 days here in the United States. So we do not start the clock rolling from the time the non-resident alien was here in the United States early. The person is not considered to have obtained their residency status for U.S. tax purposes until August 31st, when they first step foot in the United States with a degree of permanency, because they just did not have enough days here to be considered to be here under the physical presence test. Now we're going to look at a different scenario, and we'll see how the substantial presence test interacts with the green card and will cause a green card holder to actually maybe not get a green card until late in the year, but because the green card holder has been here in the United States for the year 2017 for more than 182 days, then the residency period is going to start from the first date the taxpayer was here in the United States under the physical presence test. And even though the taxpayer got their permanent residency later in the year, they still are here as U.S. taxpayers because they became taxpayers under the substantial presence test. So that gives you some idea of the timing on these. Now, let's move on. Let's say you have been here for 182 days each year, and you clearly would fail the substantial presence test. The taxpayer is not governed by a tax treaty. The taxpayer has been here for 182 days each year. They would be U.S. tax residents under the substantial presence test. Well, here we have one more example of an exception where the United States is trying to be reasonable when it comes to making people tax residents. This is called the closer connection exception. If you are here in the United States for less than 1/2 of the year in any of the years, and you have a closer connection to another country. So if you've been in the United States for 182 days each year, and you have a tax home outside of the United States, and most of your ties are outside of the United States, that exception allows you to be here every year with a maximum of 182 days and still remain not a U.S. taxpayer. Now, in both the case of the treaties and in the case of closer connection exception, at the end of the year, the taxpayer who is claiming these benefits is going to have to file documentation proving up the reasons why they are claiming the benefits and why they're entitled to the same. We're now going to look at another very exceptional circumstance. And the reason I use the words very exceptional circumstance is because it is the type of visas that are granted to students. And this leaves room for some abuse. And I'm going to explain exactly what I'm talking about. If you are a foreign student who has obtained a proper immigration status to be exempt as a student, you will not be treated as a U.S. tax resident for U.S. purposes, even if you are here for a substantial time period that would originally result under the other rules as you being a U.S. taxpayer. The student visa not only permits the student to study in the United States and only be subject to tax if that student makes any income from the United States, but not be subject to tax on any of the student's other worldwide income. And the visa permits the student to have certain direct relatives accompanying that student and have the direct relatives have the same benefits as the student and not be considered to be U.S. taxpayers. And I will give you the classic example of the abuse. I represented a woman who was from Venezuela and came here for a 3-year cooking class in a university and achieved a degree. And her husband was an international banker who made all of his money outside of the United States and made $1 million a year. And because he was classified as a student also and had the benefit of his wife's student exemption, and he had only income outside of the United States, nobody ever paid a dime in tax while they were here. And so this is a very special visa that people do take advantage of. Okay, so now we've identified for income tax purposes The people who will become U.S. taxpayers for income tax purposes, people who have had a substantial presence in the United States and do not have the benefit of a treaty exclusion, people who have been here for longer than the substantial presence test, but less than 182 days, and are not U.S. taxpayers because they have a closer connection to another country, and students. The rest of the herd is going to become U.S. taxpayers if they don't fit into any of these exceptions. And as U.S. taxpayers, we need to look at 4 separate tax planning techniques to help them before they become U.S. taxpayers. Because once they become U.S. taxpayers and they're subject to tax on their worldwide income, these tax planning techniques are not going to work. We're also going to take a look at the U.S. estate tax, which falls in a whole different category, and we will see how we deal with the U.S. estate tax also. Now, there are 4 basic tax planning principles that we need to pay attention to. And I'm going to be giving very simple examples of each one of those principles. And I can tell you that in the actual tax planning, it's usually not this simple. And there are several techniques that need to be refined to make sure that people who are coming over here with accumulated wealth, which the United States had nothing to do with the accumulation of their wealth or the accumulation of their income that they're still owed, how to make sure that they are not paying taxes unnecessarily. And these are the 4 things we need to look out for. 1, we want to accelerate gains. We want to make sure that before an alien becomes a U.S. taxpayer, that if they have assets that they can sell before they come here, and either sell or do a tax transaction to make sure that they have accelerated their gains so that they come here with a basis equal to the value of their asset. Going back to our Ecuadorian art dealer, that Ecuadorian art dealer could have done a tax transaction before he became a U.S. taxpayer, and could have come to the United States and had as his cost in the Ecuadorian art $3 million. And if he sold it here for $3 million, he wouldn't have had any tax if he had done a tax transaction to increase the basis up to what the real fair market value was before he moved here. So we have as one income tax objective the acceleration of gains. Another, we want to accelerate income. There may be income coming in that has been earned and yet hasn't been paid yet, and we want that foreign investor to come here and be able to have treated that income as having been paid already, and by virtue of tax transactions that we can do. There's not necessary to alienate property in this. It's necessary to do some of the right tax planning so that income that was really earned before but's not going to be paid until after the person becomes a U.S. taxpayer, we can make that be accelerated and the income is earned when they are not U.S. taxpayers. The next thing we want to do is, what if they have a loss? We want to, instead of accelerating, being worried about the acceleration of gains in income, here we want to defer the loss. If they have a loss and they can come here, become U.S. taxpayers, and then realize and recognize their loss, they may be able to use that loss and offset it against income that they have earned here once they've become U.S. taxpayers. And the other item that we want to do, and this has become much less of a tax planning tool with the Trump tax bill, because there's not as many deductible expenses anymore under the Trump tax bill as there has been in the past. And consequently, we do want to defer the payment of deductible expenses, so when the alien taxpayer comes here and becomes a U.S. taxpayer, they'll be able to pay those expenses, and if they're still deductible under the new bill, deduct those expenses from the income that they're making after they've come here in the United States. So let me now go through a few of the examples. One, a non-resident alien, prior to becoming a U.S. tax resident, wants to make sure that he or she does not have to pay a U.S. tax on gains that has accrued as a practical matter before their residency period. This first strategy is to accelerate, meaning realize and recognize any and all gains earned by the taxpayer prior to becoming a U.S. resident. The second strategy is to accelerate income that would otherwise be paid after the tax residency date. Income payments should be collected prior to residency to avoid being taxed by the U.S. The third strategy is to defer recognizing a loss until after obtaining tax residency and becoming a resident alien, so the loss can be used against post-residency gains. Assets with a fair market value below the cost should be sold after residency. Those losses may be taken against gains in assets earned after U.S. residency. These losses can help to reduce gains from the sale of assets after U.S. residency. The fourth strategy is to defer paying deductible expenses until after the residency date. There are several types of payments, business and personal, that may be deductible from a U.S. taxpayer's income in determining the actual taxable amount. So let's give some concrete examples. Assume a resident alien owned $1 million worth of General Motors stock, and the shares were purchased at $50,000. If the shares are sold after U.S. tax residency is assumed, the immigrant, who is then a resident alien, will pay a tax on $950,000 in gains. A sale of these same shares by the resident alien before becoming a resident alien would result in no taxable gain. And if the taxpayer really likes General Motors stock so much, the taxpayer can sell the General Motors stock for $1 million, have no tax on the gain, and turn around and buy it back for $1 million and come here with General Motors stock with a basis of $1 million. Another transaction, a little more sophisticated, is let's assume we have a Spanish business person. We're looking at phase 1, 2, and 3 here. In phase 1, we have a Spanish business person who established a Spanish corporation many years before coming to the United States, had an original share value of $500,000 in that Spanish corporation. In phase two, the share cost was $500,000. The share value for purposes of reporting gain is $500,000. But now the corporation's assets are worth $5 million. What do? We liquidate the corporation before the person comes here. A liquidation of a corporation is an exchange of corporate shares for the value of the asset being distributed by the corporation. So now the asset values are in the Spanish business person's hands with an asset basis of $5 million. And consequently, if that asset is sold after residency, and if it's sold for $6 million, there's going to be a tax only on $1 million, not a tax on $5,500,000. So that's how we accelerate gains. Now let's use a simple example on how we accelerate income. In this example, and this actually comes from a case that I had, a non-resident alien owned a share in a foreign corporation that conducted business in the non-resident alien's home country, and that corporation now had $2 million in receivables that would not be collected until after the owner has become a resident alien for U.S. tax purposes. These receivables were accelerated by the taxpayers' partners in that company buying out the taxpayer's shares and giving the taxpayer a promissory note for the $2 million, the value of the receivables. And then the owners of the corporation, later, as they collected the $2 million in receivables, which was not taxable to them because they're collecting receivables in a foreign company, in a foreign business, and they're non-resident aliens. Well, for purposes of a non-resident who's coming here to the United States, when they receive a promissory note before they get here, that promissory note under IRS rulings is not an installment note. That promissory note is treated as if it's actual full payment. So consequently, the taxpayer on the promissory note had full payment on his promissory note prior to coming here under U.S. tax laws. Now that he's coming here, he's going to receive those payments on his promissory note, and those payments have already been accounted for. Now, of course, there's going to be some interest income if you're going to have a legitimate promissory note. That interest income may be taxable here, but the principal of that note is going to have been considered to be earned, collected, and paid to this non-resident alien before he came here. That's how we accelerate income. Now, there's several types of assets that you can use this on. Pension plans that can be closed out, stock options closed out. You can get prepaid rent, prepaid royalties, prepaid dividends, prepaid interest, and annuity products, just to name a few of the kinds of assets that can have accelerated income and have income from the foreigners' offshore businesses, that would never have been subject to U.S. tax while he was remaining a foreigner, but would be subject to U.S. tax when they were paid after he got here, if they weren't prepaid. So that's how we address ourselves to acceleration on income assets. Now let's talk about how to defer recognize a loss. And again, I'm going to say I'm really giving everyone some very simple examples. It's typically not this simple. It's typically much more complicated, much more thinking that needs to go into this. In this situation, we're talking about an individual who had a portfolio where they lost money in stocks. Let's say we're talking about the individual who's a taxpayer who bought General Motors stock that was worth $1,000 and now it's only worth $500. That investor doesn't want to sell his stock at a loss prior to becoming a resident alien. That loss is useless against any income. If the taxpayer had waited, sold the General Motors stock after the taxpayer became here as a resident, the taxpayer would have a tax loss as a resident alien and would be able to pay a tax and would be able to use that loss against his gains. I'm going to have another example of how we use sale at a loss. Assume a non-resident alien taxpayer purchased an apartment in their home country at the high end of the market for $4 million, and it's now worth only $3 million. Assume the taxpayer will be immigrating to the U.S. on January 1st, 2019. Assume the taxpayer invests $100,000 in a U.S. corporation after obtaining tax residency and sells the U.S. corporation after obtaining the tax residency for $1 million in excess of the cost and would otherwise have a $1 million gain to pay taxes on. Now, if the foreign investor sold his $4 million apartment after he got here and sold it for $3 million, the foreign investor would have sold the apartment at a loss, and that loss would be able to be applied against the gains that the now resident alien made from the sale of his U.S. corporation. This is a major savings in capital gains. That pretty much exhausts the simplified explanations of how we obtain our objectives. Now, there's a whole other area of the law that I'm also going to pay a little bit of attention to, and that is the non-resident alien and the estate and gift tax area. The United States will charge estate and gift taxes on non-resident aliens on certain assets that they have in the United States. We need to make sure that they stay away from these traps because it's a very expensive trap, the estate and gift tax for the non-resident alien. When we're talking about the estate and gift tax, we really have two concepts in mind here. One is the alien who is a resident for the U.S. income tax purposes and not a resident for U.S. estate tax purposes. And now, in that situation, we have to be very careful because a taxpayer who is not a resident for U.S. estate tax purposes has a few types of assets, only a few, that they will be subject to a U.S. estate tax on. One of the biggest stumbling blocks is real estate. There are many, many people here in the United States who are income tax residents, not estate tax residents. And if that's the case, and they are holding United States real estate when they pass away, they are going to be very surprised to see that they have only a $60,000 exclusion before the United States estate taxes are applied to the wealth that they have here in the United States. It's not the $11 million exclusion that the typical American enjoys. It's a $60,000 exclusion. And real estate in the United States is subject to that particular tax. There's a few other assets that are U.S. assets that also fall in that category. Certain types of securities holdings. I'm attaching the Internal Revenue Code section that would point out exactly what assets are subject to the U.S. estate tax with only a $60,000 exclusion because you are not a U.S. tax resident for estate tax purposes. Now, once a non-resident or alien taxpayer becomes a U.S. taxpayer for estate tax purposes, then they are going to have the same benefits that the typical American has when it comes to most of the laws. There's a few examples where if you are only a U.S. resident for estate tax purposes and not a U.S. citizen for estate tax purposes, that you will have a different kind of exposure, and you need to be careful there. The definition of residency for estate tax purposes is a person who has acquired a domicile in the United States, even if they're living there for only a brief period of time, and they had no definite present intention of removing themselves from there. That's your definition of residency, and it's a dangerous code section for those who are not really versed in the traps that are lying here.